Hello and welcome back to my channel of Learning Made Easy with Rohit. This presentation is Financial Accounting Part 3, Debits and Credits. The learning objective of today's class. After today's class, you will be able to explain the rules of debits and credits. Now, what are debits and credits? You will be surprised to know that this is one of the most easiest and elementary concept in accounting. But sadly, in my teaching career, I have seen many students getting confused unnecessarily on this very easy concept. No, it is not actually their fault. It is the way these kind of concepts are explained in many books. And also some teachers take a little bit longer and technical and complicated way to explain this seemingly very, very simple concept. But I promise you, after this presentation, you will be able to explain these rules without any confusion. Now, before we get there, let's first understand what is double entry accounting. The accounting system that we use in the world today is based on double entry, which means that every transaction that you make in business has two parts. One is debit and one is credit. I will say again, every transaction, no matter what transaction you make, will have two parts. One is going to be a debit and the other is going to be a credit. At the end, your assets must equal to liabilities and shareholders' equity. So what that means is all these business transactions have to satisfy the rule of the accounting equation. And just to recap, the accounting equation is assets is equal to liabilities and owner's equity. A T account. See, these T accounts are basically accounts. For example, your cash account, your land account, your building account, your furniture account, your truck account, your automobile account. Any account is basically a T account. And the reason why we call them a T account is because they look like a T. On the balance sheet, the way they are expressed are in the form of letter T. And there is a reason. And the reason is that we have to record debits and credits on either side of this account. Okay. So what is a T account? T account is basically an account that basically looks like a T. On that account, anything that comes on the left side is a debit and anything that comes on the right side is credit. I will repeat, when it comes to debits and credits, this is the only one rule that you have to and must remember. Only one rule. Debits come on the left side of the account and credits come on the right side of the account. Nothing more, nothing less. And there goes all your confusion. Debits on the left side, credits on the right side. Now, when we are engaging in business transactions, any example you can take, okay, you go out to buy groceries and you buy a gallon of milk. That's a business transaction. Now, when you ring it or when the customer service agent is going to ring it and you make a payment, transaction has happened. For that transaction, there is a debit and there is an equal credit. And again, those debits and credits are satisfying your accounting equation, which is assets is equal to the sum of liabilities and owner's equity. Now, there have to be some rules. Okay, when we talk about accounting, we have to follow some rules. And these rules are when you record an increase in assets, you have to record on the debit side. When you record a decrease in assets, you have to record on the credit side. I will repeat this, okay? When you increase your assets in the business, the record is made on the debit side, which is the left side. And when the assets go down, or when you register a decrease, have to make a credit entry. On the liabilities, increase in liabilities are recorded on the credit side, and decrease in liabilities are recorded on the debit side. Shareholders' equity, increase records on the credit, and decrease records on the debit. Okay, I'm going to say again, assets, you increase on debit, decrease on credit. Liabilities, increase on credit, decrease debits. Shareholders' equity, increase on credit, decrease in debit. Now, assets and liabilities are pretty straightforward. Okay, because the thing is, when you're recording these entries, either something is an asset or a liability, so that is pretty straightforward. You will know exactly what entry is needed. But when it comes to shareholders equity, it becomes a little bit complicated, and the reason is that shareholders equity is being affected by your net income or net loss. Now, if you remember what we spoke about in our previous videos, the net income or net loss flows to the retained earnings, and retained earnings flows to the shareholders equity section of your balance sheet. Okay, so just for a minute, think about it. Net income is coming to retained earnings. Retained earnings is coming to or flowing to your balance sheet on the shareholders equity. Okay, now imagine you have a business. When you earn revenue, when you sell your products and service, you make money. That increases your net income. If you have expenses, for example, you pay for rent, you pay for insurance, that decreases your net income. And at the same time, your retained earnings is getting affected. So, if you earn revenue, it gets recorded on the credit side. The reason is because revenue is increasing your shareholders' equity. And we know that shareholders' equity gets increased on the credit side. So it is but obvious. Anything that increases shareholders' equity also has to be recorded on the credit side. And vice versa for anything that decreases your shareholders' equity. So let us say you are paying for rent and you are paying for insurance or you are paying for fuel. That's your expense. What is that doing? That is decreasing your net income. And because your net income is decreasing, your retained earnings is decreasing. And because your retained earnings is decreasing, your shareholders' equity is decreasing. So what does it mean? That means that anything that decreases shareholders' equity has to be recorded on the debit side. It's because shareholders' equity goes down on the debit side. It's decreased on the debit side. So expenses decrease shareholders' equity. That's why expenses are recorded on the debit side. Dividends decrease shareholders' equity. That's why dividends are recorded on the debit side. I will leave this slide open for about 15 or 20 seconds. Please have a look at it. And I would like this information so you can, to get absorbed. Okay. Try to understand what's going on. Because I promise you one thing. If this is one of the most important slides of the entire series, if you remember these rules, 50% of accounting you have already understood. Okay. So these rules of debits and credits. And it is very important for us to clarify these concepts. Okay, so I'll say again, assets increase on debit, decrease on credit. Liabilities increase on credit, decrease in debit. Shareholders' equity increase on credit, decrease in debit. And anything that increases your shareholders' equity, like your net income or your revenue, is on the right side, which is your credit. And anything that decreases shareholders' equity, like your expenses and dividends, are on the left side of this account. Normal balances. Normal balance is very easy to understand. Normal balance is any balance That is where it is expected. That's it. Anything that you expect, if that thing is there, it's normal. If you expect something and it's not there, for you, it's abnormal. So in terms of accounting, since assets are increased on the debit side, a normal asset account in normal circumstances must have a debit balance. For example, if you have land worth $50,000, it's going to be recorded on a debit. So that means the normal balance of an asset is on the debit side. For example, cash also. If you have $100,000 in your bank account, has to be on the debit side of your business account. It cannot be on the credit, is because credit, the asset is going down. So it's almost next to impossible, except only a very specific or certain transactions. Most of the almost 99.99% of transactions, your asset normal balance will be on the debit side. Coming back to the land example, you know that land is going to go up on the debit and go down on the credit. So if you have $50,000 worth of land and you decide to sell it, when you sell that land, you will have a credit entry. That makes your balance zero. Imagine your land account. Debit 50,000 when you purchase that land. And when you sold that land, credit 50,000. Balance becomes zero. And having a credit balance on the land account is not possible. It's because you cannot sell land that you don't have. How can you sell something that you don't have in normal circumstances? Okay, so that is the concept of normal balance. Asset accounts are going to have normal balances on the debit side. Liabilities, shareholders' equity, share capital, retained earnings is going to have balance on the credit side. And this is because of the rules we just spoke about in the previous slide. Dividends will have a debit balance, revenues, credit, expenses, debit. These are the normal balances. Basically, in other words, these are the balances on the side of the account where you record an increase. I'll say again, listen to this very carefully. These normal balances are the balances on your account on the side where you record an increase. So assets increase on the debit side, so you have a debit normal balance. Liabilities, shareholders' equity, share capital, retained earnings increase on the credit side, so you have the credit balance. Dividends, when you record a dividend, increasing the dividends, debit side. When revenues increase, credit side, and expenses, debit side. As a word of caution, okay, see, assets and liabilities are straightforward, as I said before. But my advice to you, if you are a new student of accounting, when you are thinking about all these debits and credits, especially the ones linked to the shareholders' equity, I would like you to think about them in relation to the shareholders' equity account. Do not think of them as standalone, otherwise you're going to get confused. So when you're thinking about revenues, expenses, dividends, and things like that, think of what effect they are having on the shareholders' equity account. And then you will remember, oh, the shareholders' equity goes up on the credit. So anything that increases shareholders' equity is a credit entry. Anything that decreases the shareholders' equity is a debit entry. That brings us to the end of this conversation. In our next video, we will talk about the impact of business transactions on the accounting equation. Thank you very much for watching. In the comment section below, please let me know your thoughts about this content and what other topics you would like me to explain to make learning easy for you. Finally, please don't forget to hit the like, subscribe, and the bell icons to get the latest notifications of these videos. See you soon in the next class. Till then, take care of yourselves.